All right, Peter and Matt from ALAO, straight from New York. Hello, gentlemen. Welcome to the show, guys.
Sam, thank you for having us. We're excited to be here.
Yeah. Well, what typically with like the dual or multi-founder thing, I always think is fascinating. So I'm excited to dig into that. You guys are building something coming out of investment banking. You got all kinds of exit opportunities with quote unquote real jobs, but it's nice to see some folks get attracted to the crazy world of entrepreneurship. And what you guys have put together makes a lot of sense. We've got one of our companies from cohort one, Audily, who we are a customer of
Sponsoring this.
availing ourselves of their service right now, right? They're in the media space, and so I've seen like how crazy it is when you get like the right influencers together with good businesses, and you guys are intimately familiar with all that stuff. So I'm excited to dig in, but maybe start with the beginnings when you both met. I'm sure there was kind of a pre and post meeting in terms of how the ideas kind of percolated with you guys. Tell me the story of how you this wonderful
Yeah,
couple met.
it's like we're getting married. Matt and I went to Penn together. We can't get rid of each other. So we were at Penn together, longtime friends at Penn. Then we both went to Goldman Sachs, and now we're doing this. So I live with a notification on my phone saying somebody's AirPods have been following you around for about 8 years now. But so Matt and I went to Penn. Matt studied finance and accounting at Wharton. I did new technology and entrepreneurship also at Wharton. We met early days, and I, given my major, have always been interested in entrepreneurship and wanted to be a founder at some point in my life. That's kind of a nice way of saying I had a bunch of shitty ideas throughout college that I could probably get a couple people excited about. Matt tended to be the person to be like, that's a dumb idea. I don't think that's going to work. And so
You need those.
yeah. And so who knows how many unicorns we passed up on because Matt shut him down. But when we were at Goldman, we'd seen a couple of trends that we'd be happy to dive into, but I had the very small inkling of what would become ALAO. And at that point, I would just go straight to Matt with any of my ideas, because if I could get it past him, I figured I could get some other traction as well. And he was pretty much like, I think this has legs. Let's run at it for a bit. So we worked on ALAO, or what would become ALAO, for probably 8 to 12 months while still working at Goldman, just sort of on weekends and in our free time. And then finally left Goldman back in December to do it full time.
It's quite the jump. Matt, I'm sure you remember that a little bit differently.
Yeah, I mean, I definitely realized at some point that he was tolling me with all of his different ideas. But I think it's nice when you're working in banking, you're working with a lot of super mature companies, and when he comes with like a new idea that hasn't been tested, you think about things differently, and it's kind of those thought experiments that I actually really liked. And yeah, ALAO came around, and well, the idea for ALAO came around, and I figured, why not? Let's jump on board. And Peter can tell you kind of the trends that we saw that, really gave us the conviction to dive in on it, and, that there was a market opportunity. But, I would say that this was one of the many ideas that he came up with, and this would happen to be one that I jumped on with.
Yeah, there's usually a very different moment between like, oh, I think this is a good idea, and some like real validation where it's like, oh shit, no, this could really, So what did that look like for you guys?
Yeah, I think so. He came with me with the idea probably, 18 months ago, almost 2 years ago. And then it was just, trying to build on, these core theses that we had of, moving toward the ownership economy. Of course, that's very vague. And we were like, what does this even look like in practice? And what's the market look like? So, the next 6 months were just a lot of calls, a lot of customer calls, a lot of check-in calls to, kind of see one, how it would work. And if, people would be interested in it, it would be calls with influencers, calls with companies, calls, of course, with lawyers. And, after I think, probably 3-4 dozen of those calls, we realized that there is a way to approach this, and a way to approach this that, is scalable. And that's kind of, I guess, the short of how we came into it.
And I think it'd be helpful to sort of set the scene with what ALAO is, because then some of those conversations we can get into, and it'll make a little bit more sense. But while at Goldman, we saw a bunch of themes that we were really excited about, and most of them sort of sat in this broad movement towards the ownership economy. And you saw this with the rise of crypto and DAOs. You saw it with the rise of directed share programs at the time of IPOs. You saw it with just the explosion of brokerage account openings over the last couple of years. It's clear that today everybody's an investor and they want the chance to invest in and potentially profit off of the culture that they interact with on a daily basis. And today, unless that's crypto or a publicly traded company, it's really hard to do that. We think crypto is still very scary and confusing to a lot of consumers. And oftentimes the most exciting things you interact with on a daily basis aren't publicly traded companies that have been around for 50 years. And so we wanted to find a way to simply facilitate investments into culture broadly. And we started doing a little research and stumbled upon what's called regulation crowdfunding, which pretty much would let us facilitate investments into private assets from both accredited and non-accredited investors. And it was great. That was one of the early findings that we were like, okay, there could be something here. And in March of 2021, a new regulation was passed that pretty much enhanced the capabilities of Reg CF. It made it a little easier for companies to use Reg CF to raise money. And probably most importantly, it raised the total funding limit from $1.07 million per company every 12 months to $5 million per company every 12 months. So it effectively 5x the market. And we thought, we were excited about the space. We thought the private markets are going to become more and more active, more and more liquid. And now is probably a great time to jump in and get involved given the recent regulatory changes and the broader excitement around the space. And so we're starting with startups, and our sort of differentiator is we connect each startup that we're bringing onto the platform with a relevant influencer or celebrity. And the thought there was, while we were at Goldman, we saw a lot of companies were taking public had mega celebrities on the cap table. Like Jay-Z was early in Robinhood, Serena Williams sat on the board of Bumble. And it's obvious what this can do for.
I didn't know that. So I didn't know Serena.
Yeah, no. And she's been doing it for years. She obviously just retired from tennis to do it full time at Serena Ventures. And it felt like sort of the mega celebrities are recognizing that investing privately is a great way to diversify away from just the traditional endorsement deal model and hopefully get something that grows alongside you. I think Kobe Bryant said something along the lines of like, I could sign a $200 million endorsement deal, but at the end of the day, that's all cash and cash runs out. If I find a way to supplement that with equity, I become an owner, and it's really the only way to create generational wealth. And we figured with the explosion of Instagram and TikTok, there's a whole new brand of celebrity that doesn't have millions of dollars to put together their own fund like a Jay-Z or a Serena Williams, but they have an incredibly powerful marketing engine that can be impactful to early stage consumer companies. And we wanted to make a way for celebrities of all sizes, anyone with influence, to simply invest into early stage consumer companies and then let anyone invest alongside them, because we think this next generation of consumers wants ownership. They want to feel closer to companies that they're supporting. They want the companies to align with their values. And it's becoming a way of personal expression, what you consume, what you own, et cetera, et cetera. And so we're really excited about the idea. We think startups are just the start. We think we can do this with all types of privately held assets and really give people the ability to invest in, interact with, and hopefully profit off of culture.
Yeah, that's an interesting way the way that you think about it. So, the way from an outsider, for me, it looks like, you're managing, a go-to-market with a three-sided network, more or less. Right. And cold starts are, if you can manage a cold start, you're off to the races. But I think you guys have a pretty clear way to do it, but maybe take me through how you guys think about, obviously it's a big part of what you do, your logo is like a triangle, so it's like, you think about this stuff pretty carefully. Maybe take me through like each one of those sides of, the investors, the influencers and the companies, how you guys are thinking about them, who's the right people, and, how to get them all to kind of work together. Maybe just take me through those.
Yeah. So I think we started at first trying to build up a library of influencers and celebrities, and we got decently far, but it became increasingly clear that influencers and celebrities want an actual idea of what they're getting into rather than a vague, we're going to roll companies onto the pipeline and then you'll be able to look at them and decide if you want to engage or not. So we kind of moved from that to now taking deals directly to the conversations that we've had. We've built relationships over the last year with managers, with talent agencies, with individual influencers and celebrities to bring them actual ideas. I think that's as a result of us realizing that the startup portion and company portion was coming easiest. I think that the value proposition came through clearest. It's a way for you to ingrain your community. It's a way to get an influencer on board. It's a way to lower customer acquisition costs at a time when a lot of these consumer facing startups are in, their margin squeeze due to like Apple tracking transparency and other data privacy regulations. So we were getting a lot of inbound interest from companies. It was very clear that they were interested. So then we, flipped it and started bringing those ideas to the influencers specifically. All the while we're doing that in the background, building up our social platforms while we didn't have an app live on the App Store to kind of get people on board with the idea that we're bringing on these private investing opportunities that aren't allowed for everyone now, for non-accredited and accredited investors. And really just trying to spread like the education portion of it while we were still building. I think as we've launched, we're building on top of that social platform that we had originally built up. And now since we have companies raising, since we have influencers as part of the companies, we can start integrating with their communities. So, we're seeing from the retail side, retail investors coming from the company, retail investors coming from the followings of the influencers and celebrities, and then just the retail investors that are simply interested in investing and come to us to see these opportunities. So from the retail side, it's kind of like a triumvirate approach where they're all coming in, from different channels, and it's playing out pretty well.
And I would say, on the company side, we're being quite picky almost in which companies we roll onto the platform. We're using this as an opportunity for us to build trust and build a brand name amongst the sort of new age investor consumer. And so we want to be very stringent on which companies we bring on. We look for consumer facing companies that hopefully last year did over $1 million in sales, growing triple digits, have clear product market fit, customers who are returning to buy the product, and really have a strong product. And we try to just throw fuel on that fire by introducing an influencer. And when we think about those pairings, we work very closely with the company's founders to think about, okay, what demographics are buying from your product today? And which demographics you want to target over the next 12 to 18 months. And so to give you an example, the first company we had on is this company called The Plug Drink. It's a hangover cure / liver recovery supplement based out of LA. They did a little over $1 million in sales last year, on track to do between like 5 and 6 million this year. So really explosive growth. They've been crushing it. We love the founders. Today, their most loyal customer is the 25 to 35-year-old health conscious female who's buying the product to sort of promote liver health and maintain a healthy lifestyle. And so we connected them with Brooks Nader, who's a Sports Illustrated swimsuit model. She's obviously very fitness minded. She's about 27. She very focused and looked at amongst that community for her advice. But then they also told us over the next 18 months, we want to make a bigger push into the college demographic, the like heavy drinkers who need this as a hangover cure product. And so we also brought in Friday Beers and Jack Harlow, who we think are very great at targeting that market. Friday Beers, if you don't know, is a sort of Barstool-esque Instagram meme page. They've got about 2 million followers, and I would argue that most of those followers are college guys who are drinking pretty heavily Wednesday through Saturday and need some hangover cure. But that's a bit how we think about the partnerships there.
Yeah, that's interesting. So, what's that pipeline look like? I mean, I'm just shocked. Like we're a venture studio and like we don't invest in outside companies, but even my inbox is flooded with like people that are raising capital. And I think you're right. It's like, that's the first place to start and kind of like high grading, the cream of the crop and taking them over. So, I mean, this obviously, I wonder if you guys can talk a little bit about market environment in terms of, getting face ripped off in the A rounds and further on.
Yeah.
My read of it is seed deals are still getting done and done pretty well. And if you have a really solid kind of smaller A, it's feasible. Is that kind of similar with what you guys are saying? I mean, if you're talking over not run rate, but historical already done $1 million, they're a
Yep.
pretty good candidate for an A round. So, I mean, I'm wondering what you guys are seeing in terms of funding. Obviously, you're going direct to individuals, so it's like a totally different market. But what are you guys seeing out there?
Yeah. I think, well, first I'll talk about, I do believe what you're saying, in that, the seed market still seems to be there, whereas Series B, Seed D is kind of, done their face ripped off. I think that's part of that reason, is that if you believe in the vision of the company and, the market opportunity, and you believe that they have a product that can fit, if they're a seed stage company, they're not showing you anything that's going to make you not believe that, in 2 years and 3 years. So if you believe in the dream now, you're believing the dream in almost any market environment. So you're willing to, jump in and, I guess, take the risk. The point you made about, if you're doing $1 million in revenue, at least the historical revenue, you're likely a candidate for a Series A. I think the market climate comes into that now, where, you're seeing valuations are a little condensed. Companies don't necessarily want to take on the dilution of a full Series A at a valuation that they think is, under impressive compared to where they probably were 6 months ago. So a lot of them are treating this as like, a pre-A, like post-C kind of round to bridge, buy them runway, buy them time to grow, and then hopefully, address that Series A in the next, 12 to 18 months, where maybe valuations have stabilized from where they are now, especially in the consumer space where, and B2C space where valuations have become compressed pretty dramatically.
And we sit at like a interesting intersection, because we think the funding environment on the company side is actually quite helpful for us. There's a couple tailwinds on the company side, like Matt mentioned, with the new privacy policy. From Apple, it's harder for these D2C companies to target consumers. We think adding an influencer hopefully decreases long-term marketing spend and leads to a stickier customer. But also, traditional seed VC rounds are a lot longer than they were 12 months ago. Even if they are getting done, it's a heavier diligence burden, and you likely aren't walking away from the first meeting with a check. And so that encourages founders to think about other alternative financing solutions where we sort of fit in. But then on the retail investor side, these are a lot of people who probably are invested in the public markets, might have been invested in crypto, and have seen their personal portfolio compress pretty substantially. We've found that for people who are loyal customers of the companies that we're bringing on, this hasn't really affected them that much. They've been buying, they're familiar with the company, they've been buying it, they're very excited to support and invest in this company. On the sort of retail investor who's more just interested in investing and excited to check out different opportunities, we've seen them take longer on their diligence process, if you will. They're more likely to buy and test the product before investing. They're more likely to spend extended periods of time looking through the pitch deck, all of which we think are smart and long-term beneficial to us, because people are doing real diligence rather than jumping on Dogecoin and praying that it 3x's tomorrow. But it's definitely been a headwind on the investor side.
Yeah, that's fascinating. One of the things I'm curious about is, structuring this kind of stuff. I'm probably more familiar with than most. I'm curious that you guys are managing some of the tax hits that the influencers may take by taking stock kind of in return for services. If you're looking at at the same time you're raising money, you want a healthy valuation, but then on the flip side, they've got to pay tax on that top line. So how are you guys structuring that? Or is it just basically like, hey man, that's the equity is worth what it's worth, and you got to pony up for the cash? I mean,
this was probably part of the reason for a bunch of the legal calls that we had at the beginning to figure out how it actually worked, because, those tax implications, we saw them when we were at Goldman with, employees that were, looking to exercise and at the Series C when they couldn't liquidate, and then we're stuck with a huge tax hit in if the markets fall apart before your IPO, you're in some serious trouble as the employee. So most of the deals that we're looking at, the influencer contracts are done through RSUs, and taxes for RSUs are charged upon receipt of the RSUs. So you can do some cool mechanics of, I guess, how to structure the deals where you don't actually receive the shares until you're able to reach a liquidity event. Sorry. So my Wi-Fi fell through for a second. But so for instance, these deals we're looking at now, they're working on double trigger vesting. So, they trigger one at completion of the duties and, in return for, whatever efforts that the influencer has in the contract. And the second one is like a mutually agreeable date to, actually vest the shares and accelerate the vesting. So the company is holding the shares until, the date when they mutually agree. And in theory, that date is going to be at a liquidity event, that being, an acquisition or IPO.
That's why, yeah, we use RSUs too, like on a 10-year annual vest, and yeah, I they're like a secret weapon. I mean, I think it's amazing because like, our I don't know, like RSAs maybe better for like very early on where it's hard to value them, but
it's hard to make the argument when they're raising money at a valuation.
Right, exactly. So it's like, you kind of want to delay it. I mean, we're getting to the point where it's like people are vesting their first year of RSUs, and it's like, this is a tough tax situation.
Yeah.
But I mean, most companies, I just hated the fact that options have a strike price that gets totally manipulated. And then like later stages, if you create that as like, hey, this is how we do comp, then in the later stages, your strike prices are pretty close to fair market value. And then you've got total disalignment of incentives between management and shareholders. And, they just want to fucking Monte Carlo roll the dice. Whereas, the owners who end up being teachers and firefighters get screwed, and I think, frankly, I think it was part of the great financial crisis was, that disalignment of incentive. But anyway, I mean, it's
no, we agree. I mean, options.
I could talk your ear off on that.
Options are tough. I mean, we think we're big believers in the ownership economy and the power of ownership and democratized ownership and the sort of pride that it gives people in order to continue growing whatever that underlying asset is. That being said, the structure around ownership is tricky, and we're excited to see sort of the employee stock option movement continue and grow. And we think, now almost every startup is giving stock to employees, but I do think, I think as a whole, we've yet to find the perfect solution for
it. And I mean, from a negotiating tactic, if you think of it in a company perspective, you're trying to bring on talent. It's hard to, offer them something that's, really enticing when the strike price they're coming in on right now effectively makes their shares worth zero. Whereas if you can communicate that, the shares are worth the delta between zero and where they currently are, that's a much more enticing opportunity and an easier conversation, especially when you're working with influencers and celebrities who are getting paid, $10,000 for an Instagram story, and they're used to, an actual figure being thrown around as soon as they're offering their services.
Yeah, for sure. I mean, we certainly found that like, bringing on founders, is like a big part of what we do. But then, after they build out a senior team, once they start hiring that like VP layer or like specialists and technicians, it's like it's post 49A. So it's like, hey, these are what your RSUs are worth. There's no like trickiness. It's just like, hey, this is what it is. It just over time, and then if you get acquired, it's all vested. So it's interesting. Tell me a little bit about creating the relationships with these folks in the in the influencer space. I'm sure it's a totally different conversation working with someone who has a manager versus no manager, pros and cons to both. How have you guys started that outreach? Because I'm sure celebrities get, flooded with all kinds of stuff. You guys are offering them, something that's not a crazy person that's going to murder them at their house type of outreach, which I'm sure that's most of it. But you may be able to come up a little bit above the fold. But how have you guys found success in reaching out to them?
Yep.
You know, what has been unexpected there? I'm curious kind of what it's like working with celebrities.
Yeah, I mean, of course, it's a different conversation when there's a manager involved, but we are, making the same points of why they should be looking at equity opportunities, whether a manager is there or not. The manager, a lot of the times, will be pushing for cash because they want the cash, right away, and that's how they get paid. And they're, short-term thinkers a lot of the time. But when the things Peter was mentioning about, Jay-Z, Beyonce, they've kind of created this idea that people can actually get equity in the businesses that they're offering their marketing services for. And that's how you actually, create wealth. And, I think people have seen that. They don't necessarily know how it works, but they're enticed by the idea of equity. And, then it goes into the conversation of education. And the conversation we have with them is that, you're getting all this money right now. It pays your rent. It's great. But similar to how you look at investments in the public market, you should be looking at your revenue streams that way as well, where you're diversifying. You're not stopping doing pay per post, but you're looking at, opportunities that you really appreciate over time. And if you believe in your ability to storytell, because that's really what influencers and celebrities do most of the time is they're master storytellers, then you should be able to help the brands grow, and you should want to participate in the growth of the brands that you're helping, instead of, just sitting there watching a brand reach, 10x the revenue when you started working with them and you have nothing to show for it. So I think that's probably the most potent argument that we have when we go to influencers and celebrities is that, make sure to diversify the way you're looking at things. You don't know if you're going to have this following forever. And really, engage and align yourself with the companies you're working with, because it comes off more authentic when you're, posting about it to your community. I think that's a big problem that's been happening. And, as influencer marketing has become more and more status quo, is that people are just coming across as they're just shilling, different opportunities. And, that's never good, because people, now just start scrolling through and they see what they think is an ad. So I mean, I think, we found that, it comes off as more authentic. It comes off as more genuine to their community, and it's really shown.
Yeah, I mean, I don't think anybody would tell you that like Joe Rogan doesn't actually believe On It is the shit. You know what I
Yeah.
mean? Like there's definitely stuff out there you can find where it's like this great, pairing that just makes a lot of sense.
And also some
So
influencers have been looking to get involved with equity deals, but they're not familiar with the diligence process that a lot of VCs go through, and their manager oftentimes isn't familiar or doesn't know how to look at a company and evaluate it as an investment opportunity. And I'm not saying Matt or I are the best private market investors that have ever been born, but we spent a decent amount of time in investment banking learning how to do a lot of those diligence processes. And so for some, it's incredibly welcomed, because they've been looking, they maybe had a couple offers here and there, but have had to pass because they don't know how to evaluate that offer. And we're coming and saying, hey, like, we'll evaluate the offer. We're only going to bring you deals that we think are worth something. And if you like it or enticed, let's have a conversation with the founder. If you don't like it, no hard feelings. We'll come back next time we think we've got a match for you.
yeah, it almost seems like that in and of itself could just be, business. But tell me about, the investor side of this, I'm sure regulatory is a nightmare, and dealing with individual investors, I'm a little bit familiar with, and know that is a lot of fun. So what does that look like for you guys in terms of, I'm sure that there's a huge skew in the median and mean, here between, you get onesie, twosie investors, and then probably a couple of whales that just like change the picture overnight. What does that look like for you guys in terms of, managing these investors, and, how are you kind of thinking about that side of it?
I guess we'll start with, while including the retail component comes with a lot of challenges, both regulatory and marketing, et cetera, et cetera. We think it's an incredibly valuable part of the platform, both for companies and investors. Investors, obviously, because we're giving them opportunity to deals that they have been left on the sideline in the past on, but companies, because you're able to engage with your community in a really new and enticing way. And you see in the public markets, stockholders of specific companies have like a 2.7 times LTV to that company versus somebody who doesn't hold the stock. And we think that only increases as you move further down the funding cycle because you feel closer to the founder. You feel like you're taking a part of that growth. And so we're bringing companies the opportunity to not only increase their marketing with an influencer, but invite their community to become stickier customers, brand ambassadors. And it creates sort of an army of micro influencers of people who are buying your product, telling their friends and family that they should look at your product. And we think, we go back and forth on which side is more valuable to the company, but a lot of times we think it's actually the community involvement. So we're incredibly passionate and excited about that side of the platform. That being said, working with the SEC is a lot like going to the DMV. Everything that you need to do takes 4 times as long as you think it should. They obviously have a lot of regulations in place to, at the end of the day, protect the everyday investor, which we obviously think is very important, but it makes parts of the process a little tedious. But we use regulation crowdfunding like we already talked on. That was first legalized in 2016. So it's had about 6 years to sort of mature. And the process of specific offerings is fairly straightforward at this point. Matt, you can jump on anywhere you think I missed.
Yeah, I think you made a good point about, the onesie twosies versus the whales that come in. Of course, our minimum investment is $100. So you do see a bunch of people who are coming in to kind of dip their toes in the VC landscape and just, kind of feel what it's like to own a piece of an early stage company. Whereas the larger checks that we see come in and the larger investors are those that have a pre-existing, almost relationship with the companies that are raising. They've been customers for years. They believe in the product and they have real conviction that it can grow. So I think, that's the way we want it to be, where people are coming in directly from the companies. They believe in the vision. But then there's also this, cohort of thousands of, retail investors almost that are willing to put in $100 or $200 into this company and see where it can go. But I wanted to touch on that because I thought it was a good point made.
It's interesting, the diversity that you get there. It like totally skews the process. It's fascinating because they have like different needs and desires, and it's like, how do you market to everybody? With kind of optimizing each one. It's interesting, and like you guys, I think that everybody kind of inherently wants to like do well for the little guy and make it like as interesting and enticing and get him involved as much as possible. And then you get like one investor that's like investing the same as like 1,000 of those folks, and you're like, God damn,
it's much easier with this way.
What? Right. Yeah.
Yeah. And I was going to say, I mean, of course, it's for us, the volume numbers are the same in that scenario. But for the company, having 1,000 people almost didn't know about your product before. They're talking about you at the dinner table. They're being brand ambassadors, as far as like a customer lead generation goes, that's very powerful for them and really can help them reach that next step in, the top line growth I think they're looking for.
Yeah, I think you'd be hard pressed to find another operation like yours that improves both, their ability to execute on the capital side and top line the same way that you guys are able to help them do. So I mean, it's pretty fascinating approach. When you guys look at, the road ahead, what do you guys see in the next, call it year and a half that you're going to be, focused on? Is it more or less, the product platform is complete and it's just kind of executing on the path? Or are there more kind of like future roadmaps here or approaches that you guys are excited to implement? Or is it mostly just like, hey, we've got the strategy, let's just crank it out of the park and put some volume through it?
Yeah, I mean, I think so. We're starting with startups, as Peter said, because we think the education from the public markets is there and people understand what a stock is. They understand what a share of a company is. They understand how valuation generally works. And that's kind of what we wanted to use as our Trojan horse into the ownership economy. As we think about our roadmap for the next 12 to 18 months, it's definitely, continuing to iterate on the product, continuing to interview customers, find out what they want in a product, find out what they're looking for, whether that's, increased social capabilities, increased messaging, to really learn from the founders and, increase the look at financials or scenario analysis. But as far as the vision goes, it's building out those, horizontally once we have this community into the different verticals in the ownership economy. That can be, investment in music, that can be investment in entertainment and TV, that can be investment in sports franchises. And really starting to launch those, I think, we'll plan to do a couple of those at least in the next, 12 to 18 months that give people a little bit of diversification within, the private, alternative investments market that's already diversified from the public markets.
And when we think of sort of private markets, private assets that you can use to invest in, we like to bucket them into two categories. One is dead assets, which are assets that you shouldn't interact with if you're using it as an investment. If you buy a collectible car, you probably shouldn't drive it. If you buy collectible trading cards, you shouldn't play with them, or they may depreciate in value. Masterworks, Rally, all collectibles, they all sort of democratize ownership in this dead asset space, which we think they do a great job at. It's exciting. Most of the assets do appreciate in value, so it could be a great investment opportunity. We're much more excited, though, about live assets, which are assets you can interact with. And actually, by virtue of interacting with them, they should increase in value. So if you invest in a startup, you buy the product, you tell family and friends. If you invest in music, you loop the song on Spotify. If you invest in a TV show, you hold viewing parties. We think we're creating armies of brand ambassadors around these live private assets that, by virtue of ownership, the asset should actually increase in value and hopefully lead to this virtuous cycle where everybody's better off. And so we're starting with startups, but we quickly want to expand into other live private assets because we think the future of the economy is all sort of based on this power of democratized ownership. And we want to be the go-to platform for alternative investments amongst the social media generation.
Amen, brother. So I usually like to wrap these things up with a question, shoot it to both of you guys, which is, there's been launching a new business is very tough, difficult, gut wrenching. I'm sure there's some things that if you go back to 18 months ago when you guys were kicking around this idea, you would have loved to have known. So is there anything that you know now that you wish you knew then when you guys were first starting out?
Oh, too many to count. But I think, a lot of it boils down to, one, we started an app and neither of us know how to code. So that was, issue number one that we were dealing with, bringing on team members, being thoughtful about the team members that you bring on, because, they're going to be your family for as long as the company exists, as long as, your roadmap keeps moving on. I think it's, a little bit cliche, but the biggest thing is like knowing what you don't know and asking questions when you want to. I think a lot of us have a preclusion to, trying to be the smartest person in the room. I know I try to be way too often. And, when you're in a startup, there's tons of things you don't know. And if you really, bog yourself down, if you think that you can solve everything on your own and, learning from others' mistakes, really talking to, other founders that have been where you are, and, they can save you a lot of time and realistically. And when we're, starting this company, time is money, literally with our burn rate. So we're definitely focused on, maximizing and optimizing for time. And I think the best way to do that is to ask questions and learn from others that have been in the position you're in now.
I'll go like a little bit more actionable, although I echo everything that Matt said. I think we initially were like, this is such a great idea. Of course, people are going to be excited about it. We just have to run 3 Facebook ads and bang, we're going to have 25,000 people ready to invest privately. And what we've learned is that it takes a long time to build up trust amongst the community. And there are better ways to do that than Facebook ads. And so we've shifted our focus to be more community focused, whether it's education materials that we help put out, whether it's office hours that we try to hold sort of once a week. And I think we could have been more prescriptive about building the community ahead of actually launching a product. You see a lot of companies sort of do that community-led distribution nowadays. And I think, I think we're in a good spot now. We're in a better spot than we were 3 months ago. But it takes time to build up trust and build a community. And if you could build a community ahead of actually launching the product, you have an innate understanding of what those people are looking for what they want in a product. And hopefully it can save you a lot of time because you're creating those relationships as you're in the development process. So you can iterate before actually launching a product that you just hope people will love.
Yeah. Rock on, guys. Well, Peter, Matt from ALAO, thank you very much for hopping on.
Thanks.
It's been a pleasure. And I wish you guys all the best. And I think you got an exciting road ahead, John.
Sam, thanks for having us. This was fun.